Budgeting allows an organization to plan and prepare its budgets for a specific period of time. It entails going over previous budgets, identifying and forecasting revenue for the coming period, and allocating funds to various costs. Senior management, your finance team, and budget managers from across the organization all contribute to a successful process. Consider your budget as a means of putting your business strategy into action. You've determined the company's priorities and goals for the coming year, and the budget allocates financial resources to meet them. There are 7 key steps in the budgeting process. Let's take a look at each one separately. Number 1. Examine the previous time period. The first step should always be to review the information you already have on hand. And in this case, the previous budget is the best indicator of how your new budget should work. Here are a few things to think about. Did you end up spending more or less than you planned? Did your predictions about the industry and your own development come true? Were there any unexpected roadblocks or shortfalls, and if so, what were they? Was the budget simple to implement? Was it followed by the rest of the team? This should be done at a high level for the entire company, and individual budget managers, if you have them, should be encouraged to do the same for their own scopes. Consultation with other team leaders is also important at this stage. The best budgets, as we'll see, are collaborative, and you'll need to know how well the previous budget worked for all parties involved. Number 2. Calculate your current revenue. The most obvious place to begin any budgeting exercise is to determine how much money you have available. Of course, there will be additional costs, but we'll get to those later. You must identify income streams at the corporate level. How much money do you make on a daily basis? List your main products, their prices, and the volume you expect in the coming year for each. Naturally, there will be some guesswork involved, and the results will not be perfect. You'll be using investor capital or venture debt to fund startups that aren't yet profitable, or don't have any paying customers at all. So, for this stage, you'll need to figure out your burn rate, how much of the total investment you're willing to commit for each time period. Number 3. Make a list of fixed costs. Fixed costs, also known as overheads, are those that you have little control over. Most importantly, they are unaffected by your sales. Whether or not the business succeeds has no bearing on the amount you pay. You can budget for these costs if you know your employee headcount for the year and have your office space and insurance in order. Number 4. Variable costs should be included. Typically, variable costs are considered discretionary expenses. These are more fluid and can be tinkered with than fixed costs. The term discretionary does not imply that these expenses are unnecessary or frivolous. A company cannot grow without marketing, and team perks can help keep employees happy for longer periods of time. However, when putting together a business budget, these expenses must be justified more rigorously. Variable costs are usually the first to be cut when you're on the verge of going over budget. Number 5. Make plans to spend more money. Are there any one-time costs on the way? These can include a major merger or acquisition, consultant assistance in preparing for an audit, or even a once-in-a-lifetime event or party. If at all possible, separate these sporadic expenses from your regular expenses in your budget. You should account for them in your budget, but they won't be a key component for many years. Consider creating a rainy day fund. Because the only certainty is uncertainty, it's a good idea to set aside some money in case something unexpected happens and you need a safety net. Number 6. Examine your cash flow. This is where the budgeting process begins. You should now have a clear record of expected revenue and expenses, and hopefully one for the previous period as well. Was your spending in line with your expectations? Are you able to spot seasonal effects in your revenue, or did you have consistent revenue over the last year? The relationship between money coming in and going out is referred to as cash flow. You want to know that you're spending money that you planned for, and that if your income drops, you'll be able to adjust your expenses accordingly. Look for obvious signs that certain aspects of your budget may require extra attention. You should be aware of the aspects of your business that have the greatest impact on your budget and be prepared to adjust accordingly. Number 7. Make decisions about your business. Naturally, you'll need to put everything you've learned from your research and preparation to good use. And that necessitates the creation of a detailed spending plan for the future. The Balance has a simple annual budget template, and Google Sheets has a great one. The most difficult part of the process, of course, is deciding which projects or priorities will receive funding and which will not. This can be stressful, so we've compiled a list of best practices to assist you. The most important thing is to try to stay consultative throughout, gather feedback, and rely on your skilled team members' expertise to guide you. You'll almost certainly make changes and updates throughout the year, so rely on the information you have now and don't get too bogged down. Share in the comments if you have any tips for other small business owners.